Welcome to today's Explainer. We're diving straight into decoding the ultimate corporate playbook for institutional Bitcoin treasury strategies. But more importantly, we're taking those massive concepts and translating them into an actionable architecture for your own personal portfolio. We're cutting right through the noise today to look at exactly how the world's largest financial entities manage digital capital. Basically, we're going to show you how to build a digital fortress of your very own. Let's get into it. So, to build this fortress, we really need to completely rewire how we look at market turbulence. Check out this philosophy. We don't time markets, we harvest volatility into a perpetual Bitcoin accumulation engine. Think about that for a second. We're shifting our mindset away from that constant, exhausting stress of guessing market tops and bottoms. Instead, we're looking at a purely mechanical system that literally uses that volatility as fuel. Here's the roadmap for today. We've got 5 parts. First, the ultimate digital capital. Second, the Sailor Flywheel. Third, maximizing Satoshis per dollar. Fourth, the wealth tree architecture. And finally, number 5, the plasma engine protocol. All right, section 1, the ultimate digital capital. Let's start by establishing the macro premise here. What are we actually accumulating, and why exactly does it act as the ultimate bedrock for a sovereign digital portfolio? The absolutely crucial thing to understand here is that Bitcoin isn't just some speculative asset. It is literally stored thermodynamic work, complete with a mathematically verifiable production floor. The massive global hash rate, which is pushing toward this insane exahash scale, creates a hard physical marginal cost to mine. Right now, that puts a floor right around $54,000. And it gets wilder when we apply S-curve adoption math. If we benchmark Bitcoin against the total stock of gold, and it captures just 25% of gold's value, we are looking at a projected target of around $369,000. This is absolute digital capital. It's absolute scarcity. And it's exactly why institutional billionaires are accumulating it to hold forever. Moving on to section 2, the Sailor Flywheel. Let's see how this bedrock concept builds the core institutional engine used by the world's absolute largest Bitcoin treasury company. Okay, you've got to see this. This is the Sailor Flywheel in action. It's the self-reinforcing engine driving MicroStrategy, and the mechanics are brilliant but honestly pretty straightforward. Step 1, the company issues paper, like equity or convertible debt. Step 2, they take those proceeds and buy Bitcoin. Over a multi-year horizon, that Bitcoin appreciates, which pushes up their Bitcoin per share ratio. As the market catches on to this massive accumulation, the net asset value, or NAV multiple, expands. The market essentially slaps a premium on the company's shares. And because that equity price is suddenly much higher, boom, it becomes cheaper to issue even more paper, and the whole cycle just spins up all over again. To keep this flywheel spinning, the Treasury essentially cracks the raw, incredibly high 40 volatility energy of Bitcoin like a massive crypto reactor. It's fascinating. On one side, they distill it into what we call digital credit. Think proxy instruments like STRC. These act as a low-volatility, drought-resistant anchor that yields around 11.5%. Pretty sweet, right? Then, on the flip side, you have digital equity, which is the amplified high-volatility exposure. It's kind of like an infinite money glitch. They are literally turning programmable digital credit into the monetary fuel that powers their entire corporate operation. That brings us to section 3, maximizing Satoshis per dollar. So here's the retail dilemma we all face. How on earth does an individual investor capture this level of corporate efficiency without, having a billion-dollar corporate balance sheet? Well, let's break down the math of Satoshi density. If you go out and buy spot Bitcoin directly at today's prices, you're securing roughly 1,200 Satoshis for every dollar spent. But if you utilize treasury proxies like XXI, which trade at a discount to their underlying Bitcoin treasury, you are suddenly acquiring nearly 6,900 Satoshis per dollar. That is 5.7 times more vicarious Bitcoin exposure for every single dollar you invest. You're basically buying a slice of a gigantic corporate Bitcoin vault, but at a massive discount. But as we all know, there is absolutely no free lunch in markets. You really have to understand the trade-offs here. Getting this incredibly high Satoshi density and generating that massive cash flow usually involves covered call strategies. And yeah, you get awesome income to fund your discipline, but you also suffer severe net asset value erosion risk. Why? Because your upside in explosive, face-melting bull markets is typically capped at around 65%. So it's a very calculated and honestly sometimes dangerous exchange. You're giving up maximum capital appreciation in exchange for aggressive, nonstop cash generation. And this brings us to the hidden danger: massive concentration masquerading as diversification. Check this out. An analysis of a massive 188-position portfolio reveals something crazy. When risk-weighted, a staggering 75% of the portfolio's entire movement is directly correlated to Bitcoin. Yet somehow, this exact same portfolio actually holds less than $7 in direct spot Bitcoin ETFs. It is a total illusion of safety, and it's something you need to be acutely aware of if you're going this route. Which naturally leads us to Section 4, the wealth tree architecture. To fix this dangerous structural gap, where you have all the beta risk but literally none of the pure underlying asset, we have to build a mechanical solution. One specifically designed to harvest volatility entirely without emotion. We like to structure this solution as a wealth tree. Picture this. At the base, you have the roots. This is your patriot layer. Think sovereign debt, like short-term treasuries, giving you a stable 5% yield just to wait patiently. Moving up, we have the trunk. This is your plasma engine, those high-yield income funds that literally convert volatility into cash flow. Next are the branches, which are your Bitcoin proxies, giving you leveraged upside. And finally, all of this exists for one single purpose: to feed the crown. Pure, unencumbered, direct spot Bitcoin. Every single layer of this tree plays a highly specific, vital role in your digital fortress. All right, final section. Section 5, the Plasma Engine Protocol. This is really the operational heart of today's explainer. We're talking about the exact mechanical trigger you use to manage this tree and aggressively funnel capital right up to the crown. Enter the Plasma Engine Recycling Protocol. The rule here is strictly mechanical, completely emotionless. You take those massive cash dividends generated by the trunk of your tree, and whenever your digital credit anchor drops 5% from its high, or whenever you hit a specific cash threshold, you mechanically sweep those funds directly into spot Bitcoin ETFs. You never, ever auto-reinvest back into the decaying proxy instruments. You force that capital straight up into the solid, non-decaying asset. In plain English, this protocol behaves almost like free money. Think about it. Right now, without this system, your covered call income throws off cash that just sits there, stagnating in a money market fund. Or even worse, it just gets blindly pumped back into the very same decaying assets. By mechanically sweeping this cash into direct spot assets like IBIT on designated triggers, you're actively closing that dangerous structural spot Bitcoin gap. And you're doing it without ever having to make a single, discretionary, emotionally driven trading decision. And honestly, the most compelling part of all of this is that the quantitative analysis literally proves it works. They ran 10,000 automated stress tests across every imaginable market condition: bull, bear, sideways, you name it. The result? A 93% probability of generating positive alpha compared to just doing a passive hold. By actively harvesting those dividends and mechanically buying the dips, the simulation added a median of over $3,800 by year-end. The math just flat out proves it. Systematic harvesting beats emotional timing every single time. So, this leaves us with the ultimate question for your own personal digital fortress. Are you going to continue playing the stressful and, let's be honest, often losing game of guessing market directions? Or are you going to build an architecture that relentlessly harvests market volatility and turns it into absolute digital capital? The blueprint is right here in front of you. Now, the execution is entirely up to you. Thanks so much for joining me on this explainer, and I'll catch you in the next one.